Yo, yo, yo! What is crack-a-lackin', everybody? You'll have to pardon the computer's fan noise. The charts, the charts in front of you are live, so naturally it's using up a little bit of my lappy's energy, and it gets a little warm. So you're gonna have to forgive it. Reason for this video is because I had briefly touched on some of these awakenings that you get when you're studying the stock market and all that good stuff. And what I wanted to share with you was what one of these awakenings would be, an example of it. Now, after I showed this, yeah, look at that. Hope you can't even see that. That's how good I'm doing in the effing Forex at the moment. I was up about $3. My balance started at 50 2 weeks ago. So much for losing 75 cents. You know, I could have bought a soda. Oh man, that's embarrassing. Anyway, back to awakenings. The biggest awakening, and it relates to what Shafe was saying with his video on reverse head and shoulders. And I'll put a link to that in the description below. It's not meant as an endorsement for the purchase of any sort of commodity. I'm just doing this for educational reasons for those of you that are interested in investment for either entertainment purposes or educational purposes. The easiest thing to come up with when you're dealing with stocks or any such investment, I've got a couple of Forex currency trading pairs here, but the chart really could be for anything, okay? And what we're going to be talking about today is the difference between going long and going short. And it's going to be tricky for me to explain going short, as you got to kind of walk on eggshells for that, because shorting has such a bad reputation because it's so misunderstood. And I'll get into the details of that a little bit later on, not fully in this video, but just to give you the general idea. When everybody starts out, and this was my experience, it was very easy to look into the stock market as, you know, you got your little chart right here, and oh, man, I got to learn how to zoom in better. Fuck me. Is that gonna work? Is that gonna work? Is that gonna work? Okay. You got you a chart here, and everybody starts out with it's as simple as buying low and selling high. Okay. Well, that's not always so simple, because guess what? You don't see the rest of this chart when you're going in. You see this much, you know. So where do you go from here? Do you buy low or do you sell high? You know, where are you at? So it's very easy for people to say, oh, just buy the dips, but I mean, how do you know when the dips are? Is that a dip? Is that a peak? So it becomes a little bit tricky, and you're only looking at the stock market in one direction. And that's actually a mistake, because the stock market, or any investment market, goes in all kinds of directions. It goes up, it goes down, it goes sideways, it goes zigzag. But what we're going to talk about here is when it goes down, and the differences, and what one of the first awakenings that I believe an investor needs to come to terms with, and that's in working with the stock market as it's going down. In this example, you see what's referred to as a bearish trend. That is, of course, as opposed to a bullish trend. The reason why they call it a bear and a bull, if you ever look at the pictures of it, the bull always like has its little horns up, and he's like bucking whatever out of its way, and the bear in the picture always has its little head down as it's like eating a bunch of shit on the ground or whatever. But how do you make money on this little guy? You know, do you buy here and then sell there, or can you sell here and then buy it back here and get paid the difference between those two locations? You know what I mean? So you can actually invest in the other direction, and it's the same thing. Now, how do they do that? And I said I wouldn't get into it in this video, but I'm going to go ahead and get into it. When you short a position and you're working inside of a margin, what you're doing, you're actually contractually, you are agreeing to a contract that you will purchase that stock at a later time. And you can make the difference in the case of this spot Forex. If you hit the bid up here and then you purchase it down here, you get to keep the difference between that distance. And it's just you're working the stock in a different direction. Now everybody talks about naked shorts and this and that and the other thing. Dude, I can tell you this, in the case of spot Forex, you are obligating yourself to that purchase, and if your unrealized profit and loss peaks out your margin, okay, you will be liquidated. It's a contractual agreement, and you will lose everybody your money, and maybe even then some if you get some slippage. So, so there you go. Try it out. Try looking at the markets in the other direction, and see how it works out for you. It was an interesting deal for me when I first started doing it. It felt weird. It felt weird at first because everything in our experiences in buying retail or doing whatever, we always it's always our experience that things increase in value, and you know, they never get cheaper. So to actually be aware of the stock going down and to be able to make money from that is you know, it's a big awareness, and it's a big awakening, and it will be able to double your exposure or your opportunity, depending on how you want to look at it, in the market. So, yep, once again, this video is given for educational purposes only. I am not a professional trader. I am barely an amateur trader, and again, this is just for entertainment reasons, really. And this is not meant as an endorsement for Oanda, the Forex, or the listed pairs of the Euro JPY, Euro USD, GBP USD, Australian dollar US dollar Japanese yen, Euro dollar Japanese yen, GBP JPY, Australian dollars Japanese yen, or the US dollar and Canadian dollar. Dude, stay the hell away from the Forex. It will get into your garbage cans and make your dog pregnant, I'm telling you. All right, see y'all later.